125% tariff bombshell, the trade war that shook the global economy. Welcome to today's in-depth video analysis on one of the most significant geopolitical and economic events in recent history. On April 12, 2025, a dramatic escalation in the US-China trade war sent shockwaves around the globe. In today's episode, we will explore how China's decision to impose a 125% tariff on American goods marked a new turning point in the long-standing struggle over trade, technology, and geopolitical influence. We'll examine the historical background of the trade tensions between these two superpowers, analyze the immediate economic fallout, including the surge in consumer angst and record inflation expectations, and discuss the nuanced responses from capital markets that reflected both fear and cautious optimism. Join us as we break down the issues step by step, with detailed insights and expert perspectives that provide context and clarity amid uncertainty. Setting the stage, historical background, and global trade dynamics. The US-China trade war is not an isolated event. It represents the culmination of years of tension, strategic rivalry, and economic competitiveness between the world's two largest economies. Over the past 2 decades, China has steadily risen as a global economic powerhouse and technological innovator, provoking increasingly assertive responses from the United States, long a champion of free trade and global market integration. From the early 2000s, a series of trade disputes, tariff barriers, and diplomatic disagreements signaled that both nations were locked in a strategic contest for global influence. The US government, striving to protect its domestic industries, began applying targeted tariffs on Chinese imports. In response, China deployed a range of countermeasures, including levies and trade restrictions designed to safeguard its burgeoning industries and challenge US dominance in global supply chains. Historically, each round of tit-for-tat tariff hikes has not only disrupted individual sectors, but also unsettled the broader international trade ecosystem. The resulting ripples were felt across global supply chains, destabilizing production networks and curtailing international investments. In this interconnected world, actions taken by either the US or China have profound implications, making every new twist in their economic rivalry a subject of intense scrutiny among policymakers, economists, and investors worldwide. April 12, 2025, the game-changing announcement. On April 12, 2025, the international community was jolted by China's formal announcement of a tariff increase on American goods, raising rates to a staggering 125%. This move, unprecedented in its scope, generated immediate and far-reaching consequences for both the US and global markets. The decision was taken amid escalating trade tensions that had reached a fever pitch. Prior to this announcement, negotiations between the two nations had been conducted with the hope of avoiding a full-blown economic conflict. However, as talks visibly stalled, the Chinese government opted for a bold and dramatic strategy aimed at pressuring the United States to reconsider its own trade policies, particularly those perceived as protectionist. By implementing a tariff rate that stretched well beyond previous limits, China signaled its readiness to engage in an economic showdown unlike any seen in over a generation. This tariff hike was not seen merely as an administrative adjustment, but as a strategic maneuver intended to prompt a major realignment in international trade relationships. It represented an assertion of economic sovereignty and geopolitical intent, a challenge directly aimed at altering the balance of power in international commerce. The ripple effect on American consumer sentiment. One of the most immediate consequences of the tariff shock was the rapid deterioration of consumer confidence in the United States. In an economy where consumer spending is a critical engine of growth, such shifts in sentiment can have profound ripple effects on broader economic performance. American consumers, long accustomed to the relative pricing stability of imported goods, suddenly found themselves facing the likely prospect of higher prices. With the implementation of the new tariffs, many began to worry that the cost of everyday items would skyrocket. Market analysts and economists quickly noted that with tariffs set at such an extreme level, there could be significant cost-push inflation, where increased production costs lead directly to higher consumer prices. As inflation fears mounted, projections emerged suggesting that inflation, if it were to materialize, could climb to levels not seen in over 40 years. The specter of record-breaking inflation triggered caution among households. Many consumers began to adopt a wait-and-see approach, delaying major purchases and hoarding cash in anticipation of further economic instability. This erosion in consumer confidence was compounded by widespread media coverage and social media commentary, intensifying public anxiety. As people moved to protect their personal finances, a feedback loop formed. Reduced consumer spending, further dampening economic growth prospects, which in turn deepened the pessimism already permeating the retail and services sectors. Stock market response. A brief glimmer of recovery. Despite the turbulent domestic sentiment among consumers and the ominous economic forecasts, the stock market displayed a curious resilience in the trading sessions following the tariff shock. During the weekend trading session, significant gains were recorded in several key sectors, providing a temporary counterpoint to the pervasive anxiety elsewhere in the economy. A critical factor behind this recovery was the US government's tactical decision to install exemptions for major technology products from the expanded tariff list. By shielding these high-growth, high-tech assets from the worst of the trade sanctions, policymakers demonstrated their commitment to preserving strategic industries critical to national innovation and global competitiveness. Investors interpreted this selective exemption as a sign of forced balance in a volatile economic environment. Large institutional investors and individual traders alike began to view the technology sector as a safe harbor amid the storm, catalyzing a surge in buying activity that pushed market indices higher, if only temporarily. Moreover, the recovery in stock prices also reflected a broader strategy of risk diversification. Faced with uncertainty, investors rotated their portfolios towards sectors deemed less vulnerable to immediate geopolitical fallout, thus mitigating some of the broader market risks inherent in an aggressive trade war scenario. However, even as optimism flourished in certain market segments, many remained cautious, preparing for the longer-term impact of ongoing geopolitical tensions. Gold prices soar, the ultimate safe haven. As fear and uncertainty gripped the economic landscape, gold emerged as the quintessential safe haven asset. Historically revered as a store of value during times of financial turmoil, gold's price began to surge to record highs on global markets. Investors, scrambling for security amid unprecedented instability, turned to gold as a defensive asset. In markets around the world, the price of gold soared, reaching levels that had not been observed in decades. This rapid ascent in gold prices can be directly attributed to several interrelated factors. The anticipation of runaway inflation generated by powerfully disruptive tariff increases. A deep-seated lack of confidence in traditional investment vehicles, particularly equities and bonds, which were seen as increasingly vulnerable in the face of geopolitical strife. An urgent search for tangible assets that could preserve capital during times of systemic uncertainty. This flight to gold served as an immediate barometer for market sentiment. Its runaway gains underscored a collective mistrust in the ability of fiat currencies and conventional investments to weather the storm of escalating trade hostilities. For many onlookers, the soaring gold prices were a stark signal that the underlying economic fundamentals were under serious threat. Act 6. Economic analysis and expert warnings. Behind the dramatic headlines and market volatility lay a sober assessment from economists and trade experts. The consensus among these professionals was that the current tariff levels, now at an unprecedented 25%, signaled not merely a cyclical adjustment, but a fundamental shift in the conduct of international trade. Experts cautioned that these aggressive tariffs could irreparably damage the economic interdependence that had been built over decades. The heightened tariffs were expected to severely disrupt global supply chains, leading to costlier production and distribution networks. Erode trust among not only the US and China, but also their global trade partners, potentially igniting a domino effect of tit-for-tat protectionist measures. Increase the vulnerability of both economies to external shocks, with the risk of triggering a broader global economic downturn. Many analysts went as far as warning that the probability of a significant global recession had grown considerably. The rationale behind this forecast rested on several points. First, with both nations now entrenched in a hardline economic standoff, the flow of goods and services was expected to contract sharply. Second, the higher production costs, born out of the punitive tariff regime, were likely to be passed down the supply chain, ultimately burdening the average consumer. Third, the cumulative effect of rising production costs, suppressed consumer spending, and disrupted trade relationships would likely culminate in a prolonged economic malaise. Reminiscent of past downturns, but with the added complications of modern global interdependence. 7. The role of technology shielding a strategic sector. While the trade conflict intensified, the US government made a crucial strategic decision to exempt key technology products from the new tariff measures. This decision was yetly lauded as a necessary intervention to support a sector that is not only vital to the American economy, but also pivotal for global technological advancement. Technology stands at the heart of modern economic growth. Semiconductors, advanced computing devices, and communications equipment drive innovation and serve as the backbone for industries ranging from healthcare to defense. By safeguarding these products from crippling tariffs, the government intended to ensure that the United States would not lose its competitive edge in technology, a sector that contributes significantly to GDP and overall global influence. The exemption permitted technology companies to continue their research and development efforts with relative stability, fostering an environment where innovation could flourish even in turbulent times. Investors, recognizing the critical value of uninterrupted technological progress, redirected capital into tech stocks, further buoying the market during an otherwise uncertain period. 8. Potential future scenarios and diplomatic implications. In the aftermath of China's dramatic tariff increase, experts have presented a variety of scenarios for how the trade war might evolve. These scenarios largely hinge on diplomatic negotiations, shifts in international alliances, and the internal economic policies adopted by both nations. Escalation of trade barriers. Should negotiations remain deadlocked, further punitive measures may follow on both sides. In this scenario, additional rounds of tariffs and restrictive trade policies could be implemented, leading to even more distorted global supply chain and potentially igniting a domino effect among other trading nations. Such a development might eventually precipitate a full-scale economic downturn, affecting nearly every corner of the globe. 2. Diplomatic breakthrough and compromise. On a more optimistic front, there exists the possibility of diplomatic progress, a breakthrough that paves the way for both nations to de-escalate tensions. In this scenario, mediated by international organizations or neutral third parties, the US and China could negotiate a balanced agreement that addresses mutual grievances. Such a resolution might involve gradual tariff reductions, increased cooperation in critical technological and environmental sectors, and provisions to safeguard both nations' economic interests. Although achieving this outcome would require significant concessions from both parties, it remains a potential path to stability. 3. Regional realignment and strategic alliances. Another potential timeline sees a realignment of global trade alliances. Regional powers in Europe and Asia may step in as mediators or even as alternative trading blocs, independent of the US-China rivalry. This shift could result in the establishment of regional trade agreements that attempt to insulate member economies from the fallout of US-China tensions. While this could offer temporary relief to some economies, it might also contribute to the fragmentation of the global trading system over the longer term. 4. Economic recession and systemic reforms. The harsher possibility is that the full spectrum of negative repercussions, supply chain disruptions, sharply declining consumer spending, and sustained inflation could collectively usher in a period of deep recession on a global scale. This reality would likely prompt sweeping reforms in international trade policies and economic governance, as nations scramble to reconstruct a more resilient, diversified, and equitable global economic system. Next, in-depth industry impacts and sectoral shifts. The ramifications of the US-China trade conflict extend beyond high-level macroeconomic indicators. They are reshaping entire industries and forcing businesses to reconsider their production strategies and market approaches. Manufacturing and supply chain adjustments. Manufacturers in the United States, long accustomed to cost efficiencies through imported components, now face the challenge of drastically increased production expenses. Many companies are re-evaluating their dependency on single-source suppliers and considering diversified, localized, or alternative international supply chains. This shift, while rational from a risk management perspective, brings with it operational upheavals that can lead to temporary production slowdowns and increased costs. That shows the technology sector and innovation resilience. As previously mentioned, the technology sector has been given a safeguard through tariff exemptions. Nonetheless, tech companies must navigate a complex environment where global cooperation is still essential for research and production. From semiconductor fabrication to software development, firms must adapt to new cost structures while pushing the boundaries of innovation. The continued influx of investments into this sector, bolstered by comparatively favorable fiscal policies, suggests that technology will continue to drive economic resilience even as other sectors falter. And consumer goods and retail. Widespread expectations of rising inflation have altered consumer behavior dramatically. Retailers are witnessing a shift toward more cautious spending patterns, with consumers prioritizing essential items over discretionary luxuries. Brands that can adapt by reaffirming value propositions, perhaps through cost adjustments, local production, or innovative service models, are likely to fare better during these turbulent times. With financial markets and investment strategies. The volatility experienced in global financial markets has spurred investors to re-evaluate portfolio strategies. The shift towards safe haven assets, exemplified by surging gold prices, signals not only widespread concern over short-term risks, but also a recalibration of long-term investment paradigms. Hedge funds, institutional investors, and even retail traders are increasingly adopting diversified, risk-averse strategies designed to protect capital amid widespread uncertainty. ADEX, analyzing the broader geopolitical implications. The economic consequences of the US-China trade conflict are inextricably linked to broader geopolitical trends. The tariff escalation on April 12, 2025 should be understood not solely as an economic maneuver, but as a deliberate political message directed toward the global order. In the decades following the end of the Cold War, globalization had largely been driven by the idea that economic integration could foster political stability. However, the recent escalation exposes the fragile underpinnings of that model. With sovereignty and national interest increasingly prioritized over international cooperation, the current crisis underscores the dangers inherent in a system where economic interdependence can be weaponized for geopolitical leverage. The strategic incentives behind these policy decisions are clear. For China, the move is designed to reassert its influence on the global stage, challenging what it perceives as undue American hegemony. By imposing such high tariffs, China not only defends its domestic market, but also seeks to force a reconsideration of global trade dynamics. For the United States, the reaction to these policies, including selective exemptions and rapid market interventions, reflects a dual intent to protect key strategic sectors while attempting to shield its broader economy from the full brunt of retaliatory measures. These dynamics invite us to reevaluate long-standing international alliances and trade relationships. As traditional power structures come under strain, smaller countries and emerging economies may need to forge new ties and create independent networks that are less susceptible to the ebb and flow of US-China tensions. For some, expert recommendations and strategic considerations. Analysts and policymakers have been quick to issue strategic recommendations to mitigate the cascading impacts of this crisis. Their advice spans the spectrum from immediate measures aimed at stabilizing domestic economies to long-term structural reforms intended to re-engineer the global trade framework. Experts recommend portfolio diversification. Investors should rebalance their portfolios to include a wider range of safe haven assets. Diversification is key, not only in mitigating risk, but also in capitalizing on emerging opportunities in technology and localized manufacturing. Strengthening supply chain resilience. Businesses are advised to develop contingency plans that include diversified sourcing and regional manufacturing hubs. This can offer a measure of protection against disruptions in global supply chains. Diplomatic engagement and negotiation. For policymakers, re-establishing open channels of dialogue is paramount. Efforts to recalibrate trade relationships should be guided by the search for mutual benefit, rather than zero-sum tactics. International organizations like the WTO and IMF could play critical roles in mediating such negotiations. Fostering innovation. Amidst uncertainty, the commitment to research and development in strategic sectors, especially technology, remains crucial. Governments and private industries should continue to invest in innovation, as breakthroughs in technology tend to have a stabilizing influence on the economy over the long term. 12. Reflecting on the lessons learned and looking ahead. As the dust settles on the dramatic developments of April 12 or 25, we are left with critical lessons that extend far beyond the current US-China friction. This crisis teaches us that in a hyper-connected world, even seemingly isolated policy decisions can reverberate globally. It also underlines the perils of extreme protectionism, a tactic that, while capable of delivering short-term political victories, can destabilize economies and erode long-standing international trust. Key lessons include the interconnected nature of modern economies. The US and China are inextricably linked, and actions that disrupt one economy invariably affect the other. There is a pressing need to maintain international cooperation, even amidst strategic rivalries. The importance of resilience. Both governments and businesses must prioritize resilience, be it through diversified supply chains, flexible fiscal policies, or robust investment in innovation. Resilience is the buffer that can soften the blow of unexpected shocks. The role of dialogue. Even in times of elevated tensions, maintaining open lines of communication is essential. Constructive dialogue can pave the way for compromises that avert the worst-case scenarios envisaged by economists. The impact on society. Beyond the numbers and trade balances, policy decisions have real-world impacts on everyday lives, affecting consumer confidence, employment prospects, and overall quality of life. A balanced, informed approach is essential to safeguard social welfare. Conclusion: navigating an uncertain future. In closing, the events of April 12, 2025 serve as a stark reminder that the global economy is not a static entity, but an ever-evolving tapestry shaped by political will, strategic ambition, and market forces. As China's unprecedented 125% tariff on American goods disrupts established norms and sets off a chain reaction that touches every facet of modern life, the world stands at a pivotal crossroads. Will the crisis evolve into prolonged economic stagnation, or will it prompt a renaissance of innovation and diplomatic ingenuity? The answer remains uncertain. However, one fact is clear: the imperative for collaboration, informed policy-making, and strategic resilience has never been greater. For consumers, businesses, and governments alike, the coming months will test the limits of adaptability and foresight. Amid the uncertainty, the commitment to open dialogue, sustained investment in technology, and a willingness to embrace both diversity and innovation in economic strategies will be the guiding lights towards stability and growth. Thank you for joining us on this detailed exploration of the US-China trade war's latest chapter. We hope this video has provided clarity and insight into the multifaceted challenges and opportunities that lie ahead. Stay tuned for further updates as we continue to follow this dynamic situation and analyze its global impact.